Good morning and welcome to Trading Futures, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach. There are the bells, and that means the market's off and moving, but the futures market has been already up and running this morning, and we're going to take a look at that here in just a moment. I'm joined out there in the chat by my good friend Michael Fairborn, 20-plus year veteran of the financial markets. He is there to help answer your questions along the way. Thanks to all of you for joining me, those of you that are here on a regular basis. Good to see you again here this morning. For those of you that are just joining us, welcome. Thank you for joining. I love it. Thank you for joining the family, as Janelle says. Thank you for being here and enjoying this webcast and participating and engaging. Along the way, Michael's going to be there to help answer those questions. But if you're watching this in the recorded version, leave your comments in the comment section. That's how you participate as well. Hey, there's some stuff moving today. We just had CPI come out. We had a big news day yesterday and a big move in the market yesterday. So we'll see how that's playing itself out in the futures market today. And I've got a couple of examples that I want to jump into here pretty quickly. And then we're going to talk about something that we discussed last week and the week before. We'll see how this plays itself out here. But a couple of quick housekeeping items that we need to take care of before we get started. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not a recommendation. It is not any kind of a advice or anything else. Remember that futures and futures options trading involves substantial risk. It's not suitable for all investors. Make sure that you read the risk disclosure statement for futures and options prior to trading futures products. Remember that futures trading requires separate authorization for trading. Also, remember that as we talk about a variety of different symbols today, again, none of those are recommendations. If we talk about a virtual currency derivative symbol, specifically Bitcoin futures, which we may look at in this discussion today because it has been moving a little bit. Remember to read the NFA Investor Advisory on virtual currency derivatives and the CFTC Customer Advisory as well. Now, those are some of the things you're going to have to pay attention to. We're going to be using the Thinkorswim desktop software platform, specifically the paper money version. It is not a guarantee of future success out there in the real world, and it doesn't do some of the things that a real live trading account would do. However, it's a great learning environment and a great place to learn these skills. We're going to use some technical analysis in this discussion. There are other ways to look at the market. None of those are guarantees. They are all theoretical in nature. Now, we're also going to talk a little bit about stop orders. And I've made mention of this before, but if you're brand new, and especially if you've been coming back to this and you've started to explore this idea, remember that stop orders on futures trades and on futures contracts are not guaranteed in execution. They allow us to specify the activation price, but those orders, when they issue a market order, will be worked and substituted as an exchange-designated limit order based on a protection point or a protection range. There is the possibility that in a fast-moving market, the market could move around that range and the order would not fill. So that's something that we need to be aware of in placing stop orders and putting stop orders on futures contracts. We'll talk about that when we get into this discussion. But here's our general agenda of where we're headed. We're going to look at some futures contracts and their asset classes. We're going to discuss some aspects of, probably not into futures options today, but some aspects of hedging with futures. And we're going to look at some example trades. So let's do this. Let's pop over to the Thinkorswim desktop software platform once again, and let's kind of get right into this discussion. And the discussion that I wanted to look at really quickly as we get right off the bat is this crude oil. This is the MCL/MCL crude oil contract. And what I was initially looking at was this move higher that the crude oil contract, the micro crude oil contract, made a little while ago. And so this is a today 5-minute chart. So we see the overnight performance, and now we see this upward move, and we see this move as the market has gotten up and rolling here this morning. We see these 5-minute candles. What's interesting is when the CPI report came out just a few minutes ago, we started to see this downward move into a support level right around the 62.51 mark. And since then, the crude oil contract has started to bounce. Now, over on the left-hand side, we've got the longer-term chart. This is the one-year daily chart. And you can kind of see that W pattern that is kind of establishing itself here and building in this crude oil contract, right? Down, up, down, up. So my initial thought was looking at a move back up to this 65 mark. Then I started to see that downward move right here. And my thought was, if it breaks this support level, we may look at this as a short-term bearish trade back down into this support area, perhaps off of the 61.8 level or so. Now we're getting this little bit of a bounce here. And my thought process as we're looking at this, still from a trend perspective, may be that this is a bear flag type of move. That the initial move on the CPI numbers, which suggested that consumer prices were cooling a little bit, remains a drag on crude oil, given the fact that if we were seeing overheated inflationary prices, that would mean more consumer demand. Well, lower consumer demand oftentimes means lower energy prices. It's kind of a chicken and egg scenario here. So my thought is still bearish in this perspective. So what I'm going to do in this example, and this is an illustrative and educational example only, is I can see some strong momentum to the downside in the MACD on this chart. Now, remember, let's just take a look at the notional value and the specifications of this particular contract. So I'm going to maximize my large sell first. Tick size is 0.01. That means that this increment right here, this 62.64, or excuse me, 62.65, that increments in 0.01 increments. Some have a tick size of 5, some have a tick size of 0.10. So this has a tick size of 0.01, which means that these ticks are incrementing in single digits, right? So 62.67, 62.65, 62.64, and so on. Each one of those ticks represents $1 in value, which means that a 1-point move, so 6.2 to 6.3, in this case, to the left of the decimal, indicates a $100 move in the value of the contract. The notional value of the contract is 62.66 or 6,266, which is the 62.66. And you'll see this change times that $100. That gives us our notional value. And so you can kind of see that relationship there, right? So we can see what that scenario is going to be as this starts to move, and what that risk and reward might calculate out to be if we start to look at a particular move. Now, let's go over here. We can also click right here on the drop down arrow. We can go to this futures sub-tab, and we can go to our micro crude oil futures, and we can see what our initial margin is on this particular contract. This is a pretty liquid contract in terms of volume and open interest. And because it's a micro contract, that initial margin is going to be smaller because the contract size is smaller. In fact, this is a tenth of the large contract, the /CL, but that initial margin is going to be smaller as well. Now, remember, margins can change. This is the cost, the amount that needs to be put up in order to initiate a position in this contract per contract. So we could trade multiple contracts. It would increase that initial margin. But remember, once the position is established, then that initial margin becomes a maintenance margin, and that's going to decrease a little bit. We'll talk about that as we get into this discussion a little bit further. But you can always find that these circumstances and these specifications, tick size, tick value, and initial margin here on this drop down and in the futures list. So let's do this. Let's restore our cells, and let's come over here and let's maximize this one, because what I'm looking at now is taking this trade from this breakdown below the 62.5 level, and we're sitting right on it. And you can see it. Once again, I'm going to probably do what I do normally, which is talk through the trade, and then I miss it. But that's okay, because this is a paper trade. This is simply an illustrative example, and if we miss it, we miss it, and that's fine. But I'm going to look for taking the trade off if it goes against me up above this 62.86. And that's going to give me that perspective in terms of defining at least defining the risk. It's not going to manage the risk, right? The risk is going to be managed by how we take action on the position if the position fills. But that's going to define where we're looking at taking the trade off. So that's giving us an idea of what our expectations are. Expectations don't always become reality, do they? Just ask, my parents, right? I'm just kidding. No, they're proud of me, I'm sure. Okay, so no, I'm just teasing about that. All right, so taking a look at this move to the downside, that's our expectation, is this move down into this support level. There are a couple of levels of support on the way down where this might run into perhaps a bit of support. So this may not be a quick move. This may take a little bit to get to that point. And that being said, in this particular case, this may be a multiple day trade. So with that move to the downside, we've got the EIA report coming out tomorrow, which is the inventory report. We've also got, I think, some OPEC discussion around tariffs and other things. So this is going to be a trade that may play itself out quickly, and it may not play itself out quickly. But we're talking about a move to the downside. And the thing about it is, we can put on a take profit order, right, in order to take this off. But that doesn't mean that we're limited to that. If we start to see this going back against us in this particular trade, again, the stop or the place where we would take the trade off if it starts to go against us can be adjusted if it finds these levels of support. And that's oftentimes, I know Mike Fairborn teaches a webcast on swing trading where he talks about managing stops and moving and adjusting those stops as stocks, or excuse me, as positions find support levels. So here's what we're going to do. We're going to enter the trade if this breaks this support at 62.51. Exit if the trade breaks the resistance at 62.86. And the target for the trade from that downside perspective is down here at around 61.75. By the way, speaking of targets, we've got a feedback survey out there in the chat. Do me a favor, fill out that feedback survey, help us out making this session better. That's how we get better at this, is by your suggestions, your discussion, and your comments. So do me a favor, take just a couple of minutes. You don't have to do it right now. Do it before the end of the webcast so you don't lose the link. But fill out that feedback survey. So let's build this trade together here really quickly. I'm going to right-click at that level, and I'm going to create a sell order, but I'm going to do a sell custom with OCO bracket. Now, I just want to say this about OCO bracket orders as they relate to futures contracts, especially fast-moving futures contracts. There is the potential, because those orders, specifically the stop side of the order, could get worked as an exchange-designated limit order. There is the potential that while that order is moving and being worked, that if you have a fast-moving market that slams from one side to the other, and especially if those OCO bracket orders are close together, that there's the possibility that both of those could get triggered without the other one being canceled. So that is a challenge, and you got to pay attention to that. Now, I suspect that these are far enough apart that unless there was something, almost existential in nature, you're not going to see typically a move of 61 to 63 points in crude oil prices that quickly that those orders would not get filled. But there is potentially the possibility. So just want to bring that up and make sure that we're aware of that. So this is going to be, in fact, a sell stop order, right, to get into the trade. So we're going to change this order to a stop. And remember, this is going to be this is again going to work as an exchange worked or exchange designated limit order. And we're going to take that on a trigger. Let me just kind of move this down so that we can see what those prices are. A break below that support level at the 62.5 mark. And I'm going to make that a day order, because if this doesn't go down today, I don't want to be in the trade in this particular case, because that means something potentially has changed. So now let's go to the upside. And let's say, where do we want to take this trade off if this goes against us? And so this is going to be the buy side of the trade. So we're going to either buy it at a limit. That's going to be our target. We're going to buy it at a loss potentially. That's going to be our exit to the upside. And so that's going to be a buy stop. because it's going to wait till it gets to that price to buy it back. So we're going to say, look, 62.87. So I'm going to make my order if this goes against me, 62.87 on the upside. So 62.87. It says, fine, stop, wait until price gets to 62.87, then buy it back if it gets to that level. And again, that's going to get worked as a market order. Now, we could put that in as a stop limit order. That's fine. I'm going to leave it as that market order and let the exchange work that. Sometimes that maybe becomes a little more efficient in creating those orders and exiting those positions. So I'm going to make this a good till canceled order. And now we're going to make our take profit order theoretical profit. Again, remember, this is paper money. That if the price of the crude oil contract gets down to 61.76, which is that support level that we've drawn in here, then take the trade off. And so what we're going to do is we're going to make this a limit order that says, hey, buy it back for this price or less. So if it goes down, if we get a move to the downside that's big, below 61.76, it's going to fill that order at that level or thereabouts, right? So 61.76 is my take profit order, and I'm also going to make that good till canceled as well, just so that we have the circumstances of this order in place. Now, if this doesn't fill today, it's going to go away because it's likely in that particular scenario that something has changed here. So if this breaks up through this resistance level and this doesn't fill today, that's fine too. It means that something changed, but we're looking at our premise here, this being a bear flag type of move, and it is counter trend. So we got to make sure that we're aware of that this is playing against that trend, but based on the economic moves in this particular case. All right, so I'm going to click on confirm and send. We're going to read through the order, make sure that that order is what we want it to be, make sure that we're aware of the exchange generated transaction costs that we have to pay attention to, and then our buying power impact right here, which is our initial margin in the trade. And I'm going to put this in our futures group. That futures group is simply one of the subgroups that I've created in this particular paper money account, just so that I can keep things organized, which is a difficult task in and of itself on my part. And I'm going to click on send, and we're going to fire that order off. And now we've got kind of the circumstances of this order lined out here in this MCL/MCL micro crude oil futures contract. Now, this is a good time for me to, again, remind you that feedback survey, and thank you, Michael, for posting that in there. Second, to remind you to click on that subscribe button down at the bottom right corner of your screen. If you haven't done so already, subscribe to our Trader Talks webcast channel for no other reason than simply it makes it easier to find this content. Number one, for other reasons, meaning that it is beneficial because then you can set alerts for new content. And three, it helps to pop this content up in the algorithm. So it makes this content available for you and for others, and it's at no cost to you. And then also click on like if you like today's discussion, if you like this particular webcast. Click on that like button down there at the bottom of the page. That also helps to pop the content up to the top of the algorithm. Now that we have kind of a sense of this kind of at the start trade here and as things get up and rolling, let's take a look really quickly before we come back to a couple of these others. Let's take a look at what's going on in the market as a whole, because remember I said that yesterday was a pretty news-driven day. Here's the Russell 2000 futures. This is /RTY. A couple of things have happened in the course of the last couple of days since we talked last. One was the break above this 50-period simple moving average. Two was the break above this diagonal trend line. Three was this gap to the upside. And four was kind of running into this resistance around the 21.26 mark. So we saw some activity up around that range. RSI is still driving higher, right? RSI is still breaking above the range in which it has been. So there's still some momentum here. But the Russell is still below the 200-period moving average. One of the things that we're likely to see, given the fact that the CPI number is coming in a little bit lighter, right? We see that CPI number coming in at 2.3 year over year versus 2.4. So a little bit of a decline in those consumer prices. Food, one of those reasons. That's going to have an impact on small caps. So if the CPI is coming down, inflationary pressures are coming down, that's going to ease potentially the pressure, psychological, political, uh, market pressure, whatever it might be, on the Fed to artificially lower interest rates. Letting the CPI do that work, letting prices work, that may bring interest rates down. That may be beneficial for the Russell 2000 in terms of that move to the upside. So we may see some move because small caps tend to be a little bit more interest rate sensitive. When those rates come down, that tends to benefit the small caps and the Russell 2000 futures a little bit. If you want more information about that, by the way, Michael Fairborn teaches a great webcast, and I'm glad that I have him in the chat today. Michael Fairborn teaches a great webcast on market and sector analysis, where he talks about some of those different markets, specifically the small caps, specifically the large caps, specifically some of the sectors that are more interest rate sensitive. And he does a great job of talking about that rotation. I'll let him put the link for that webcast in the discussion here. Now, the S&P 500, and again, you see kind of a stronger, more visceral reaction here on the S&P 500 because it's a broader index and a broader futures contract. You see that moving again, the break above the diagonal trend line, the break above the 200 period moving average, and the holding above the 200 period moving average. However, from a technical analysis perspective, this is a pretty good example of what's oftentimes called a deliberation candle, right? Where you get this kind of big relief move to the upside, and then you get this candle that just says, okay, well, now we saw the big move. Now what? And lightening up in the CPI ought to be a little bit of a positive here in the sense that that means the inflationary pressures are coming down. And again, revisions are also going to tell the tale as well. That may be just kind of a pause here in terms of this move. We see a little bit of selling. There may be a little bit of profit taking, given the fact that this is up near or around a resistance level in the futures contract. It's up near the resistance level in the index price. That may be an indication that there's a little bit of a wait and see. We're also going to see PPI later today, producer price indexes. So maybe the market waiting for some confirmation on this softening of inflationary pressures. Could that potentially be that move to the upside, right? That may be fuel for that fire, but this is toggled back up above the 200 period moving average. I wanted to make mention of that for one particular reason, right? So you see where that 200 period moving average is. We look at the NASDAQ. We see the break in the 200 period moving average. We see the strong breakout of a resistance level. So you got a couple of things going on. You've got some definite bullish movement here. Now, what we did a couple of weeks ago, I want to come back over here to the monitor tab, and I want to take a look at this, is we have a portfolio of stocks in this particular account that we had hedged with a /MES contract, right? This is the micro E mini contract. And we sold two of those contracts to offset a significant amount of the deltas, the S&P 500 deltas in this account. And if you remember, we used beta weighting to do that. The question becomes, and I don't know if you've ever asked this question when you've done this, but the question is, when do we remove a hedge? We talked about the idea of perhaps being over-hedged into a big rally to the upside. And the question is, when do we have some kind of objective measurement or objective criteria to say, now's the time to take this hedge off and let the portfolio continue to run? Because you can see the weight that it is having, the drag that that is having on this portfolio performance. I mean, that's, 20% of the portfolio that is being dragged down by this downward expectation, which we're not getting out of the MES. It was there when the MES or the /ES, the S&P was going down. That's what it was there for, was to provide that downside move, to remove some of those deltas. But now that the /ES is moving higher, we're taking a loss and we're continuing to extend that loss in the hedge. Now, hedges aren't intended, I'm just going to say this, a hedging position, whether we're short the micro E-mini futures here, or whether it's an option contract or protective put or something like that, hedge isn't designed to be a revenue generator. It isn't designed to be a profitable trade. It's designed as protection. And so sometimes that's where traders get confused and they think, oh, well, this is really dragging. But that's when the ambiguity comes into place in terms of taking the hedge off. We think, well, what if it goes down again? Right? Well, yeah, that's there. I mean, we tend to anchor to recent events. And one of the recent events was this big move to the downside. That recent event looms large in the minds of traders. And we're thinking, well, do I need to stay hedged because there is the possibility? But we're now above the 50. We're above the 200. We're above some of these areas of support now. So the question is now, do we take the trade off? Do we take this hedging position off? So I wanted to kind of come back over here. There's an objective way to think about this. So I'm going to do this really quick, and we're going to jump into an idea. Now, some of you, we pointed this out a couple of weeks ago. Some of you had asked the question about how do I go about learning more about futures and kind of from a fundamental perspective. So if you're on the Schwab.com website and you go to the Learn tab on the Schwab.com website, and again, this is a demonstration account. This is not a live account. So any positions that you see in here, these are for illustrative and educational purposes only. But I'm going to go to the Learn tab, and I'm going to come down here to the Futures section over on the left-hand side. And there are a number of articles in here that talk about the futures market. There's a number of videos specifically in here. These are short form videos that talk about things like the micro E-mini contracts, the ones that we've been talking about. Talk about setting up your platform for trading futures for beginners. That's Cameron May who provided that one. There's this webcast right here. Here's some other webcasts. That's James Boyd from a little while ago. Yeah, Gary says, take the hedge off and then the market will fall. There are a lot of... Well, okay, so think about this from a fundamental component, right? You start buying back these short positions, that adds some upward pressure, right? I mean, that's like the idea of short covering. So there is some potential there where that buying pressure maybe gets absorbed by covering those short contract positions. So there may be some reality to that. Not you specifically, but the market as a whole. But now we take a look. I stumbled across this the other day because I was digging in for you guys because of the questions you were asking in the feedback survey. There's a course here called Fundamentals of Futures Trading. And you can pop into this course, and it's a great resource, right? It gives you some lessons that you can go through. It's self-moderated. You can go through it at your own pace, but there are some quizzes. You can find information about contract specifications and margin and trading a contract, portfolio hedging, and a few other resources here. But what I happen to notice, oh, and by the way, there's a final course assessment. But what I happen to notice down here was this resource at the bottom of this course. And that is this Fundamentals of Futures Trading Investing Plan. And you can download this. But I opened it up, and it's a PDF document. And I started to scroll down through this, this document. And I started to come across this idea of portfolio hedging with futures, sample investing plan. And I said, okay, maybe this gives us some insight into when to get in. And so we've used some of these, right? These entry rules into the trade. But more importantly, I came across this part right here. Let me see if I can make this a little bigger so that we can see it. Sample exit rules for exiting a hedging position, right? When to remove the hedge and could relate to the reason for entering the hedge. So again, these are simply examples. These are not hard and fast rules. These are not rules of thumb. These are not what we are recommending or suggesting, which we don't do. These are simply considerations. So some of the fundamental signals are after an announcement or an event. Well, did we have an announcement? Yeah, we had an announcement about a tariff deal. After the market discounts the news. That would be an example of a deliberation candle like we're having today, a day or two after the news events comes out, right? And then technical signals, bullish 200-day moving average crossover, and a major index breaking resistance. So if we pop back over here, so just this area right here, right? These ideas right here, that might give us an idea about when to exit a position. So I'm going to right click. We're going to come back over here. I'm going to go to my ES contract and I'm going to say, look, what did we have happen? Well, we had the 200 period moving average broken. We had a resistance level broken. We had a diagonal resistance and a horizontal resistance level broken. That meets both of those characteristics. That might be the reason to take the hedge off. So now I'm not just doing it because I feel like taking the hedge off. I'm doing it because I've got something objective that I can make an informed decision about. Plus, there was an event. Plus, we're getting deliberation as the market digests that information. So what we're going to do is we're going to close this position down and remove the hedge. And while we do that, you're going to see what this portfolio then goes back to in terms of its directional sensitivity to the upside. So I'm going to right click and I'm going to create a closing order and we're going to buy back those two contracts. Now we could do this a number of different ways. This is the way that I'm going to go about doing this. We're going to do this as a limit order. We're going to submit this order. I'm going to click on confirm and send. I'm going to read through this order, and again, remembering that I've got those exchange generated transaction costs, and we're going to close down this position. I'm going to click on send. We're going to fire that order off. This is a liquid contract, so we should be able to get this filled relatively quickly unless I talked through it. And if we can't, we might have to bump that limit order a little bit. Let's see what's going on. Let's click to our working orders here. Here's our buy order to buy this back. And 58, and in fact, it moved a little bit on us while we were talking, which is what happens because I talk a lot. Click on cancel replace order. I'm going to open up and float that a little bit here to let that float to the current price. And I'm going to keep that floated so that we can get out of this and see if we can work our way out of this trade. I'm going to click on confirm and send. Again, read through the order. Click on send. We'll fire that order off and we'll see if we can fill that. It is moving at the moment. We'll see if that order, and there we go. We got out of that trade. We've taken the hedge off. Now let's go back to our position statement here in the monitor tab. We've now reduced those deltas and we can see what our sensitivity is now. We added back in about 10 bullish deltas into this portfolio relative to the /ES futures contract, because that's what we're beta weighting to. Now we've taken that weight off of our portfolio and we've kind of opened the upside for this to continue to move to the upside. Now, here's the scenario though. When would we put another hedge back on to kind of scratch that itch of saying, if I take this off, it's going to go down, right? Because we're anchored to this downside move. Well, we've got a couple of objective points that we could use to look at putting a hedge on. And that might be the break back below that 200 period moving average. That might be the break below this support level, below the 50 period moving average. Whatever we might tie that hedging position to, we can make that be a technically driven hedge and say, look, if it breaks below the 200 period moving average, I'm going to put a hedging position on. If it breaks below the 50 period moving average, I'm going to add to that hedge to offset some of that downside movement and reduce some of that bullish sensitivity to my portfolio. So that's the idea, again, behind using a futures contract as a means to hedge. We can potentially over hedge. We talked about that. We can eliminate all of the sensitivity out of the portfolio and then it doesn't do anything, which in times of kind of abject downside movement, like a big down move, the portfolio not doing anything maybe makes some sense, but at the same time, you remove that upside sensitivity. To everything there is a season, right? So sometimes the season is let the portfolio move. Sometimes it is hedge the position. We don't leave the hedge on all the time. Yet, the psychology of traders suggests I'm going to stay hedged or over hedged, and then I lose out on some of that upside movement because we get anchored to the negative. All right, let's go back down to our charts here really quickly. Let's go back down to our futures movers grid here. That was the grid that we were looking at before. And there's let's see what our crude oil contract is doing, /MCL. and it hasn't broken down yet. It's kind of waffling around here. Now, the other one that I was going to look at today is /MGC, which is the gold contract. And you can see that gold's kind of double topping here, giving us the potential of that double top. In fact, if we were to draw a support level here off this double top, off of this potential double top, I'm going to zoom in a little bit here so we can see where that support level is. That support level is perhaps somewhere right around there, right? Now, has it created the double top yet, or is it still a potential double top? Well, you see where my support level just got drawn in on this shorter term chart. So my thought was initially, this is the other one that I was thinking about doing for that first trade right out of the gate, was the break of this support level. And then it broke and it rallied back up and it's moved back down to the downside. So we kind of missed that move. That's okay. I'm okay with that, because what I may do then in this particular case is look for, once again, the longer term move. Remember, gold has been kind of, we talked about this last week in terms of that flight to safety, the safe haven type of perspective, that there's been a lot of money rotating into gold or gold futures as that safe haven because of its intrinsic value, all of those things, those fundamental reasons. Now, as the market moves higher, as equities start to move higher, there may be an idea of investors who had rotated to the safe haven unpacking those positions for the sake of taking that capital that was stored essentially here in the safe haven and looking for more risk-on type of opportunities, which may be leading to this downside potential move in the gold contract. So what I'm going to do is put this trade together, and we're going to look for a move down here to the downside, maybe a little bit further to the downside here, maybe down to this 29.89 mark. It might not get there, and this again might be like our crude oil contract, looking a little bit more bearishly, but we're going to look at that move down to 29. I'm going to call it 29. We'll just even call it a break below the 3,000 level, kind of round to that break below 3,000. Again, let's look at the notional here on this contract. Tick size is 0.1. This is 10. So this doesn't have another point beyond the decimal. You see that this increments here one at a time. It doesn't have another point beyond the decimal. Tick value is $1. So each one of these moves from 3 to 4 to the right of the decimal is a dollar move. The point value, meaning a move from 32.38 to 32.39, is $10 in the contract. Contract notional value, 32,380. Take this price times this price and you get this price right here. That's how we calculate that notional value. So that's also going to help us to determine what our initial margin is. We can go over here to the futures contract. We can come down here to /MGC and go to our /MGC. Initial margin a little bit higher than the gold or the crude oil contract. Again, part of that is because this notional value is a little bit higher. But remember, those initial margins are going to be different because these are different products and they have different levels of risk. And these initial margins and maintenance margins can and do change based on the potential risk in the contract. That's driven by the exchanges and the brokers. All right. So let's put this trade on and we can come back over here. Let's go back to our shorter term. This is today's 5 minutes. And we're going to take this trade off if it goes back up above 32.52. We're going to take, actually, I'm even going to split that in half. I'm going to go, if this goes above 32.42 as a resistance level. So I'm going to right click and we're going to do another sell custom with OCO bracket. And we're going to look at getting in the trade if it breaks below 32.30. So 32.30 is going to be our sell stop. 32.30 is going to be our sell stop point. So if it goes below 32.30, then we're going to take the trade off at this 32.43 mark. So I'm going to come down here to my buy stop, 32.43. Whoops, 43, and we'll make that even. And I'm going to make that good till canceled. And then I'm going to look at my take profit, which is buying it back if this goes down to 3,000. right? And we're going to make that one good till canceled. We're going to click on confirm and send. We're going to read through this order, make sure that we're aware of those exchange generated transaction costs and our initial margin in the trade. We're going to put this in our futures group. We're going to click on send, and we're going to look for a breakdown below that 3230 to enter this trade. So guys, thank you very much for helping me to understand that and to walk through this. I wonder if I can post that link. I don't know if I can post that link. Vic, if I can't, do me a favor. You can follow me. You can follow Michael Fairborn on X at Ben Watson CS, at Mike Fairborn CS. Also, leave a comment in the comment section, and I will see if we can post that link to the PDF of that investing plan. And if we can't, then I will see if we can walk through that again next week as we talk about this. So once again, we've got the feedback survey out there in the chat. Thank you so much for joining me. Thanks to Michael Fairborn for joining me. We've got a lot of great stuff coming up today in our webcast lineup. If you want to learn more, you can pop back over here to the schwab.com or schwab.com/coaching. And you can jump into those live webcasts. You can also find it here. You can find those contracts, or excuse me, those courses that we were talking about here in the Learn tab. I forgot that they were here on schwab.com/coaching. You can go here to the futures section, and you can dig in and get into some of that information right here. So that's where you're going to find some of that. Some is behind the paywall, some is in front of the paywall, but again, you got to log into some things, right? And then here is the webcast page. Again, if you want to learn a little bit more about what Michael Fairborn teaches, market, sector, and here's Michael Fairborn talking about market and sector analysis. That's his great playlist right here. So have an interesting day, guys. It's going to be, I think, an interesting one as CPI, PPI plays itself out in the discussion of the market today, and we'll see what happens. Once again, thanks for joining us. Thanks to Michael Fairborn for helping out, and we will talk to you guys again very soon. If not, sooner than next Tuesday when we talk about futures again. We'll see you soon. Bye-bye.